with
breakfast.
or breakfast with.
Good morning, you guys. It's Tuesday morning. I'm Trisha Turner. It's time to rise and thrive. This is a podcast that comes to you every Tuesday, 9 a.m.-ish Central Time. We're actually on time, even a little bit early this morning, because I've got an awesome guest with you today, and we've got stuff going on he's got to get to pretty much at 9:30 sharp. So we're going to do a hard stop. So you guys need to tune in, though, because this is a right on time podcast with what's going on in the world right now. Michael Harrington is one of our preferred lenders. He has been doing this for a very long time. And today we're going to talk about all things interest rate and tariffs. So Michael, for those that do not know you, give a little bit of your backstory, if you could, please.
Oh, sure. Absolutely. So when I was 19, I got into the business. I won't say how old I am. I'll just say how long I've been doing this for 29 years. Now you can do the math, right? If you're good at math. So almost 30 years doing mortgage lending. Been top producer since I was 23 in the top 1% of America for production. So very blessed to say I've had a great team that has always been behind me. So we get things, as you know, closed on time and experienced that yourself just this past week. So it's been a fun experience trying to obviously navigate the last couple of years for real estate. And so I feel like our team has done that just by being there for our real estate agents. So.
Well, I think this is a super cool opportunity for, number one, you guys, most of our audience is real estate agents. And the purpose of this podcast every week is to bring you basically messages around the 4 principles that are most important in my life, that being faith, family, finances, and fitness. And today we're talking about finances, because the interest rates have been higher for the last almost 3 years now than we've seen in a decade. And every year since COVID in the real estate world, we seem to get blindsided by something. It's like, well, crap, I didn't see that one coming. When are we going to get back to this balanced market, right?
Yeah.
Well, we got tariffs now. And right when we thought we were going to see interest rates maybe take a breather, they are back on this roller coaster ride. Michael, what is going on?
Well, I think we have to look at the much bigger picture. It's funny because, being a pilot, we always use the term 30,000 foot view, which I've never personally flown an airplane at 30,000 feet, but because you need oxygen at that point. But we use the term so eloquently when we're talking about like taking the big picture. I think too often, and when we're reading media and the news right now, they're taking snippets like, the stock market. They say the word crash. Crash would not have been 5%. Number one, the word crash should not be being used right now. It was absolutely a market adjustment because of the tariffs. That's true. But then we've already seen like 20 plus companies come to the table, which is why, as of this morning, we saw almost like a 3% bounce back on the stocks, like almost immediately 1,100 point increase this morning. So we'll see a rebound. I mean, I called my guy when the 5% drop happened. I've had my money out of the stocks for quite some time right now. I've only got about 50K in stocks, which I had a lot more in stocks before that. I put everything in CDs after 2022 and 23 when I saw what was happening with the market. A lot of people are forgetting that the stock market correction back in 2022 also included a bond market going in the wrong direction, which is unusual. Usually when people are getting out of stocks, they're putting money in bonds. So let's look at what the bigger picture is right now. So our country has to renew its like almost 5 to 7, I think $7 trillion of debt this year. 2025, it comes due. So let's talk about this like our country as if it was a borrower. In 2023, our credit rating with Fitch got diminished in 2023. Okay, that means that's like if you were a borrower and your 720 score went down to 680. That's what happened with our country. So when our debt renews very, very soon, we're talking significant amount of debt. When it renews at a certain rate of return to whoever we owe it to, which is ironically some foreign countries, and then ourselves as well. We owe ourselves a certain amount of debt. So if that is at a higher interest rate, that's not good for our debt structure, which is already teetering on let's just say it, on the brink of bankruptcy, because the amount of GDP versus how much we actually have in debt. I mean, you've watched that debt calculator just soaring higher and higher every single day. We have got to fix that. No one has fixed it. So I always say you can't play chicken if you're not on the road. Okay. So we are playing chicken right now with a lot of countries to say, look, we have got to restructure our agreement with you because we're running a deficit. The word deficit, that means we are literally borrowing. We're borrowing money at a wrong rate. We have goods coming over at the wrong rate as well. So if we don't correct that, like I hate to say it, but we kind of have to shake this tree and make sure that we actually have apples coming down right now. And unfortunately, that's just not happening with these countries. So we have got to correct that deficit problem that we have with multiple countries, meaning that they're the ones winning, we're the ones losing.
Yeah.
And if we don't do that soon, that Fitch rating has everything to do. The one that would change back in 2023 has everything to do with the fact that our debt structure is going higher and higher, just like your credit cards would. If you were only making $50,000 a year, but your credit card debt was $100,000, how are you going to correct that if you're only making 50 grand a year? Yeah. What's your credit rating going to do if you've maxed out your credit cards? Yeah. That's what this country has done. It's maxed out its credit cards. Okay. Its credit rating is sinking sand right now. And if you look at other countries that happened to, Zimbabwe, Venezuela, what happened to those countries? The dollar sank in those countries, and then inflation went through the roof. We've already seen what can happen with inflation in our country. Last 4 years, 23% increase on all goods. If you actually add up all the inflationary years, it was 23%. That's how much we're paying already. Before the tariffs even happened, we're paying 23% on everything, not like specifically wood to build a house or specifically chickens. We're talking or eggs. Like it was, everything went up. We were like that slow boiling frog is what we were. So I think the tariffs, again, not getting political, but I think the tariffs are to shake this tree to make sure that we've got apples coming down that we're going to be able to eat. And unfortunately, like I said before, you have to get on the road to play chicken with these countries. If we don't do it, if we don't do what we're doing right now, it's just going to be the same game that we've been playing for the last 50 years, which is just increasing debt to a structure that we are not going to be able to sustain long term. And if that credit rating goes from AA plus down to A, all bets are off.
I love, number one, thank you for explaining it like that, because you simplified it, which is what we should be doing, simplifying the market, because a confused mind just says no. So buyers are confused out there. Homeowners are confused. No one really understands what is going on. All of a sudden we thought, not to get political, but we thought this year was going to be all right, we're going to have this soaring economy, and lo and behold, it's not. And right now, what are tariffs, and what is going on, and what are interest rates doing? They're relentless. And this is such perfect timing that you're on today, because I was with a new construction sales manager Sunday afternoon talking tariffs. And he told me, Trisha, I need you to get out there and deliver the message that we are seeing notifications that perhaps in third and fourth quarter, we're going to see an increase in our cost, of course, to build these homes because of tariffs. And so buyers already are struggling with affordability, as you know, Michael. What is the cost increase going to do to the real estate industry? What's your thoughts on all of that?
Well, number one, the fact that people are paying attention to the tariffs and interest rates right now is it's a great sign for consumers. And this is the message I really want to get out today, is that people are calling me, they're calling you, because they're like, wait, what's this mean for real estate? At least they're asking the question. Before, they were just sitting on this massive fence, not doing anything, because they're in their minds, I'm just going to wait for the rates to come down. Well, if you wait till the rates come down, if you wait until it happens, it's kind of like waiting for stocks to go up, and then you're like, oh, I need to buy Apple. Well, why would you want to buy it when it's at the highest?
Right.
Like I said, a few days ago would have been a good time to buy some of those stocks that had tanked 10 to 15, 20%, because they're already up 3% today.
Yeah.
How high are they going to go up when we start reaching actual agreements with these tariffs? Everyone's always reacting to the news, or the actual infinitesimal amount of time that it takes for something to drop. I always say, credit's like a cliff. It's easy to fall off of it. It's harder to climb up it. Same thing with stocks. I mean, you want to climb up the stock market, right? You want to climb up it. And if you did put your money in stocks in the last 5 years, you did extremely well, right? Because the stock market has, in my opinion, I've said this for years, for the last year, I've said, I think the stock market needs a correction, because I feel like it's almost inflated. Like the stock market itself is inflated.
Yeah.
Well, what happens with interest rates? So inflated and then correction on stocks. What usually happens, and that's exactly what happened last week, we saw a major swing in the bond market, the 10-year treasury, where people were putting their money into safety nets, right? They're putting it into things that are safer than stocks, because they don't want to be stuck on the down on the stock market. So now, yes, yesterday and today, the opposite happened with rates, right? Rates went up yesterday again. Why? Because again, we're reaching agreements with these tariff countries to the point where it's like, oh, well, now we're reaching agreements, so things are looking better for stock. I want to put my money in stocks again. So, rates can move the same way stocks do. But I do think, like, based on what I've been reading, obviously, we heard that the Fed was going to make possibly 3 more cuts this year. Of course, the Fed came out and said an opposite statement to that. I think it was yesterday morning. And so it's like, okay, the Fed's like making confusing statements now because, we're going to have 3 cuts. Oh, no, we might not cut at all. So that's, I think, also why the bond market reacted yesterday I think we were down 84 ticks, which is like the equivalent of like 0.25% in interest rate. And so it's like, okay, meaning it went up another quarter, but it was down at like almost a half point last week. So it's like it's fluctuating almost like the stock market. So you do have to kind of catch things on a swing. It's going to be interesting to see what happens over the next 6 months. I do think rates progressively will go down in the next 6 months, which is why we're calling all our past clients, reminding them, hey, talk to me first. Don't listen to. Obviously, you heard about the thing with Mr. Cooper and Rocket Mortgage and Redfin. So it's like, as real estate agents and mortgage professionals, we have got to make sure that the consumer thinks of us as their valet, their VIP, their person that's going to take care of them from a wealth building strategy standpoint. So right now, if you're not calling all your past clients, I mean, this is literally the message that we're getting out in Go Coaching, which I'm a coach for, is you have got to call your last 2 years, if not just the last 6 months of individuals, and make sure you're putting a bug in their ear that they come to you if they have questions. You need to be the resource, because the news is extremely confusing. Let's just say this, because of politics, the news, like depending upon which news station you're watching, they're telling a completely different story from one another, right? So it's like, they need to come to us as the professionals that can read markets and read actual numbers. Like, data doesn't lie, right? The numbers don't lie. So if you can actually read actual numbers of what's happening, whether it's payroll, whether it's farm, whether it's, like you said, building houses that are going to be more expensive to build because of the tariff situation. It's going to relay the cost of wood, because most of our wood comes from Canada. Some of it's actually now coming from Mexico. Not as good wood from Mexico as from Canada, according to the builders I've spoken to. Hence the reason they're like, we really need to get more wood from Canada. The wood's better, they hold stronger. So let's not build a house with the wood that's down south, because again, the wood's not, I'm telling you, like they said, the wood's just not as good. It's not as strong. And so it's like, those things are really happening with builders, where they're having to analyze how we're going to get our lumber. And then if lumber costs more, we have to charge more to the buyer or the consumer. And if the prices of homes go up, then that helps everyone for resale, obviously, but it doesn't help when a new home buyer that still makes the same amount of money, didn't get a 3.5 or 6% increase in their pay, they're having to buy a smaller home for more money because they waited. And so the message I think that we all have to get out is 2 things. These are the 2 important ones, right? Is if you wait until rates come down, until prices go up, you might have to pay over list price because of a multiple offer scenario. And that cash has to come out of your pocket, because the last 6 months of appraisals are lower than what you're going to be paying for that house. The lender's not going to lend you because you're paying $50,000 more dollars. We're going to give you whatever the value is times that amount that you're putting down. And then you're going to have to put the cash difference between that down as well. And you're going to have this is the second thing, limited amount of inventory. So you're going into a limited amount of inventory. So you get to pick from 2 houses instead of 10.
Yeah.
You're no longer in the driver's seat as a buyer. The seller's in the driver's seat. The seller's saying, great, bring me 10, 20 offers, and we'll decide which of the 10 to 20 we're going to decide from. And I hate to say it, sometimes sellers look at, are you on a government loan or are you on a conventional loan?
Oh, yeah.
They're not supposed to be discriminatory, but they can say, well, you're putting 3% down. This guy's putting 50% down. Which one looks more secure as an offer on the table? The 50% guy, right? Or the cash offer that could be coming from, California. Most of the people coming from Cali, they got so much equity. They're just coming here and paying cash for homes, honestly. I hear from loan officers all over the country, and they're like, half the deals coming in right now are cash. They're not even getting mortgages. So, which is great for you, not good for us.
Yeah. But it's crazy, Michael, because I had this, again, like these are daily conversations I'm having with different resources. I got interviewed from the Houston Chronicle yesterday, and she was asking me questions about this. And I said, number one, it's too soon to tell, because this is just taking effect. So these are things that we'll see, signs of in 3-6 months from now, like you were just saying. I said, but what I do know is that Homes are still sitting on the market. Homes have been failing to sell in most areas for now 18 months. And so what ends up happening with that? Well, sellers need to sell. They need that equity. A lot of them are in financial situations. They need the equity out of their home. They're dropping the price of their home to get it sold. What does that do to the surrounding comparables? They're going to have to follow suit or they're not going to sell. So I told this lady yesterday, I said, what you're going to see, and we're already seeing it, is 90 days from now, 6 months from now that we're actually seeing sales, thank the Lord, but they're at a much lower price. They're not selling at 98% of list price. They're at 96% of list price. What will that do? And as we stack supply, and I told the lady, I said, what you got to remember is that if these tariffs cause new construction to increase in price, it'll be an amazing thing for resale homes that are sitting, that's for sure. But at the same time, the buyers out there, just like you just said, Michael, they're not making any more money. So if the home is costing more, we still have homeowners insurance that's through the roof, and we have taxes. So our housing affordability is still a problem, and people are not going to be able to qualify, which I think, like you just said, will drive them to resale. What's your thoughts?
Well, obviously resale, you can get more square footage right now than you can if you're doing new construction. I find new construction, they're building lower square footage on purpose. They're doing 1,200, 1,300 square foot homes. If you remember, not too long ago, they would never have been building 1,200 to 1,300 square foot homes. Now, in other parts of the country, if everyone's listening on this call, in other parts of the country, 1,200, 1,300 square foot home, like in Boston, is extremely normal. Retail or resale or new construction, it would be the same. That's about the average size of a house up there. It's not a very large home. But down here in Texas, as we say, everything's bigger in Texas, including our toothpicks, right? And so our houses are bigger. I mean, when people see the size of my house that I bought when I was 27, my friends I'm from New Hampshire were like, "Oh my gosh, would you buy a mansion?" I'm like, "No, I only paid $240,000 at the time. I paid $240,000." I mean, I literally paid $242,000 for a 4,000 square foot house on a lake that was a Coventry house. It's like, I can't believe today what the value of that house is.
For sure.
And so when we're talking to consumers, we have to talk, I'm not saying down to the level, but we have to talk to them in analogies. And so, because right now it's so confusing what they're hearing online. So when I'm talking to a first-time home buyer, I'm simply saying, look, if I was to take all my mortgage payments that I've made over the last 30 years, because I've owned houses for 30 years, okay, since I was 19, if I took every mortgage payment, because I know what my mortgage payments were, I just have them memorized, right? I had 3 houses, I had a certain mortgage payment. I've added it up. I've added up the cost of renovating the homes before I sold them. I've cost the renovation of my current house, even the windows, which, by the way, if you buy windows, you're not moving. Because
they're very
it's like putting solar panels on your house. It's like, well, I'll never get that money back. So I even I added the $39,000 it cost for all the 30 windows I have in my house. And so I've added it all together. And here's the thing. I've lived in every one of my houses for free. Because if I know what I sold the first 2 homes for, and I know what I could sell this house for. So if I sold my house tomorrow, I lived in all my homes for free. I never paid a mortgage, really. I mean, because yes, I did. But if I take all the equity, the earnings I've made over that time frame, I've lived there for free. You cannot do that with renting. And so if I've done the mathematics in front of a consumer that said, "Oh, I'm just going to rent. I'm going to rent." I'm like, look, I used to have the same mindset as you when I was a first-time home buyer, and there's grant programs there. I mean, I'm doing T-Shack right now for a consumer that's getting 3% at 6.5% interest rate. It's a forgivable loan, so he has to stay in the note for 3 years plus in order to not have to pay that back in full. So there's recapture aspects to doing a down payment assistance program. But the key is he's getting 3%, right?
Right.
At 6.5%, which is about where the FHA rates were at the time that I locked him in.
For sure.
And he's getting 3%. There's really no cost to him other than staying in the property for 3 years and not refinancing during that time frame. So there's programs out there people don't know about. I mean, our company is signed up with everything, including even the housing voucher program, which consumers don't even know that Section 8 does both housing voucher for rental as well as purchase. And so it's like people don't know until they know. And so unfortunately they do Dr. Google, instead of talking to a real mortgage professional or more real estate agent to get the right information. So I would say if a consumer's listening to this podcast, or even if you're a realtor listening to this podcast, you got to educate in order to actually like get people to understand the current scenario. There's no books like written about down payment assistance that's accurate. And the reason why is because they keep changing. The program parameters change. The amount of money that's available for down payment assistance changes. You saw all the programs that the government is taking away right now. I'm just being honest with you. Like they're taking away specific programs because of the DEI aspect of those programs. Those programs are being removed from our coffers of programs. And so we're having to come up with programs that are just aimed at first-time homebuyers in general and not aimed at specific DEI aspects. So it's like we're having to change our parameters of how we're going to dish out funds for down payment assistance. I think cities and counties really need to come forward with the money that they have to help generate some housing money for those locations. Yeah. I've been talking to the city of Katy. City of Katy even has like $2 million for tourism that they haven't touched yet. Well, what if we took that and put that towards housing allotments, like maybe just small amounts to help consumers get into homes, their first home here in Katy. I mean, again, I had help with my first house. I'm not sure if you did. I did down payment assistance for the city of Houston, and that gave me $9,500 to buy my first home. I mean, I could not have bought that first house without that assistance. I was 19 years old. Right. Now, some people might say, yeah, but were you a responsible person at 19? Yeah, I had a mortgage to pay. I mean, right. You know, but here's the thing, if you're paying rent, it's due on the first, right? Like after the first, you could, on the day 4 in Texas, you could have someone standing on your doorstep, a sheriff, and asking you to please put your stuff in the garage, and they could remove you from the premises on day 4 in the state of Texas for renting. They can't do that in a mortgage. In a mortgage, if you lost your job tomorrow, the mortgage company would want to work it out with you and say, you know what, just pay us before the 30th day is late so that way you don't have anything on your credit. Like there's no workout plan when you're renting. Like the landlord wants their money because they just paid a mortgage, and they're going to be on you by day 4 to say, you got to get out of that house. So when people are like, I feel better about renting, I'm like, if you lost your job, I guarantee you'd feel better about having a mortgage than having a landlord or a sheriff at your doorstep on day 4 of not paying your rent. So sorry, I digress, but I want to make sure the importance of the differences between renting and owning a home. It's just like, if you can use your own personal analogies, if you're a real estate agent and you've owned homes or you own investment properties, like use your real stories, use the stories of individuals that you've helped to help like tell that story to a consumer that just, they don't want to understand. They don't want to hear just numbers and things. They want to hear like someone's story. They want to feel what you feel as, you know, why you got into the job that you got into, whether it's real estate, mortgage, or the consumer that's just trying to, you know, find the right place to get into.
I'll ask you this, and going back to tariffs, because that is, again, the big talk of everyone right now. When you're looking at the ramifications of the tariffs and we're looking at new construction, and again, neither one of us are experts and neither one of us have crystal balls, but it's probably safe to say that we will see the cost of home building increase. Mm-hmm. Do you think the tariffs will have any impact on a resale home? Period.
On resale, no, I don't. I really don't. Only because it's going to take a while for new construct. Like builders are going to have to take it on the chin a little bit because they can't raise prices during a time that we don't even have multiple offers going on. So like they'll be sitting with inventory. Now, what builders might do is, as we've seen what happens with the tariffs, is like the car companies, like I think it was a Range Rover, decided to just stop building Range Rovers because they import to the US and they know that the US is not going to pay a major premium on those vehicles. So they just stop construction. So what I would say is going to happen, and we've seen this happen in the past too with builders when they know the cost is going to go up. It did that with lumber just a few years ago as well, is they might just stop building all spec homes being houses that are going to sit and wait for the consumer to come and see the house. So what they might do is just build the models and then build with contracts that have $20,000, $30,000, $50,000 of earnest money before they'll even start constructing that property. So I think they might do that. And then that way, hopefully wait out the tariff situation to see if the cost of lumber comes down before they actually have to put lumber up. And so I think they're either going to go to other countries, unfortunately, because like I said, Canada would be our best country for import for lumber, according to all the builders I've spoken to. And it is a serious topic. Like I'm talking CEOs, CFOs, and CEOs. I talked to a COO across the table from me, and he is very concerned about the cost of Canadian lumber. And he's personally from Mexico. And he's the one that told me, Michael, we don't want to build with Mexican wood. We really need that strong wood from Canada to build our product. And we want to be building with basically wood that's not going to hold. And so their concern is, how are we going to offset the cost? Are we going to have to start taking things from overseas? And then would that have to be, double, triple the amount of product coming across? And would you have to buy in bundles from stuff overseas and then hold on to that in warehouses? And they're contemplating warehousing wood at a cheaper cost from overseas versus taking it like a couple houses at a time from Canada. So you got all these conversations happening with builders. Now, what that's going to do to resale, obviously we want resale to either stay at or above whatever it's at, because we don't want to have a resale coming down because new construction is doing better than resale. What we have seen in the last 6 months, Trish, is a lot of realtors are aiming towards new construction for a reason. I said this when the NAR settlement happened. I said, you know what? Realtors are going to start taking buyers to new construction because they're guaranteed, quite frankly, their paycheck. With resale, they don't know if they're going to get their full paycheck, right? Like, that's the risk they take. And I said, new construction is going to still, in Texas anyways, and parts of Texas, still be paying bonuses and paying the realtors their full commission. In most cases, obviously there's a few builders that don't, but most builders for that matter are advertising, hey, we'll pay you your full commission. Well, if you're a real estate agent, you're going to get your full commission. I mean, you're going to not steer, but you're going to say, well, let's go check out new construction first. See if you like that before we go see this resale home that, hasn't had an updated kitchen in 10 years. It's like, they're going to go for the easiness, right? And so resale in the last 6 months has been hurting. I mean, this has been hurting because new construction is so desperate to get stuff off the market. They're offering, buy downs, permanent buy downs down to like 2.99%, and then you go there and you're like, wait, is it 2.99 or well, yeah, if the buyer comes up with 25 grand, I had the consumer that came back to me for new construction because they were promised 2.99. They came back and said, yeah, that was all a gimmick. I'm like, well, gimmicks happen, so I'm sorry. But I think that has hurt resale in the last 6 months. I think resale is going to do much better these next 6 months as rates come down. I think we're going to see a lot more consumers going towards resale because inventory is high with the builders, but at the same time, their commitments that they've made for interest rates, lower interest rates, if rates come down, those commitments are going to hurt the builder cost wise. And it's forward commitments from lending institutions that offer those lower rates, but they've made promises to keep those rates. So when rates do come down, that actually hurts that forward commitment aspect because they thought that was what they were going to be selling for the next year. And if rates come down, resale is going to do better. So I think in the next 6 months, I think resale is going to do better. I think new construction is going to be in pain points because they're going to have to try and make up for their loss of profit if they were sitting on inventory. And I think you're going to see builders stop building inventory because of the tariffs.
I think it's so crazy. It's like real estate, people don't understand, like real estate is seriously, you have to be very strategic. You have to understand what's going on to best guide people and educate people because it's such a huge swing. Just like you said, yes, resale has been hurting, but at the same time, resale has been hurting also because of the cost of homeowners insurance. So when you insure a brand new home, your premiums are half or greater than that of a resale. So now we're going to have to kind of look like, how does this weigh out? Because what is going to be the cost of a new home once these tariffs are all in place? What is how's it going to affect building versus insurance versus interest rate? And then look at that pendulum versus resale. I think honestly, like if you're in real estate and mortgage, if you're not studying this market, like back to school, you're crazy and you're going to lose and you're going to not be a good resource for these consumers that are out there hearing just constant garbage from the media and no one giving clear direction.
Well, you made a good point about the insurance. Obviously, if the roof is older than 5 to 10 years, right now, it's hard to even find insurance companies that will insure the house. So good point. But let's take the counterpoint to that on new construction. Most new neighborhoods are brand new MUDs or municipal utility districts. So that you're paying 1 to 1.25 just for the mud alone if it's a new community until it takes time. Like Cinco Ranch is a good one because it's 20 years old, right? With newer phases and older phases. So if you go to the older phases, your total tax rate might be 2.6, 2.7. But you go to a brand new part of Cinco Ranch or a Cross Creek Ranch or one of these Jordan Ranch and so forth, they're 3.7.
Yes.
It could be as high as 3.7% for taxes. And people are like, why are the taxes so high? I'm like, well, you have this horizontal construction, which is all your streets and sewers and everything else. And unfortunately, when you have all of that, that has to be built and paid for.
Yeah.
So there's bonds that are associated with that. And so in the beginning of a neighborhood, you're paying for it as the consumer that bought in the neighborhood, because your mud rate is the highest possible. It takes years before it goes down to just maintenance of those streets and sewers and stuff. So, you know, if you're in Old Town Katy, you're not paying any mud. You're paying 2.2 to 2.4%. It's one of the reasons I actually looked at houses in Grand Lakes when we were moving down from Frisco, Texas. Well, Frisco, Texas was 2.2. So when I went to the newer parts of Katy, I'm like, I ain't paying 3.7% taxes. I moved into Old Katy. So it's like, I was all about the taxes. I'm like, I don't want to be paying twice the amount of taxes as what I was paying where I came from.
No.
So you do have people moving here from other states that pay very, very low property taxes, and they're not used to the high homeowners insurance. And so, yeah, homeowners insurance. So here's the thing with resale versus new construction. New construction, you'll be paying very low homeowners insurance and very usually higher taxes if it's brand new.
Yep.
And then if you're in resale, you're going to be paying higher homeowners insurance and lower taxes. So
it's crazy.
It kind of evens. If you're selling either one, there's your selling points. Like, well, yes, but you know, you pay lower taxes. So
one thing, but a final thing, because I know you got to go, but you touched on it, so now we have to bring it up.
Yeah.
Mr. Cooper, of course, and Rocket Mortgage and Redfin. Okay, for one, and I'm not talking bad about anyone, but Mr. Cooper has a terrible reputation. Terrible. Yeah. And because there's a lot of chatter in the real estate world, and you see ads running in media about all of this. Can you simplify that? What's going on, please?
Sure, absolutely. So I always use the analogy of oil and gas companies, because you see them do these major mergers, and I always say it's about control.
Yeah.
So Mr. Cooper's president is now basically going to be the CEO or president of Rocket, right? Which we know is Rocket Mortgage. So the move tells me that the whole thing is, it's about AI and trying to understand the client way in advance of them making a move. If they paid $9 billion for something, they're thinking we're going to make 30 to 40 billion during the refi boom, and we're going to have control of those clients and the conversations, because we're going to automate this whole process, which is why I said at the very beginning of our conversation, it's really, really important to be that voice, an actual physical voice to the consumer. Pick up the phone. Don't do an automated text. Don't do an automated email. Don't do a mailing. Like, pick up the freaking phone and touch base with every one of your past clients and make sure that you're the referral source. They have a reason to refer to you. There's a value that you still bring to the table. So make sure that's absolute. Because if you don't, you have a good 1 out of every 6 mortgages is serviced by Mr. Cooper. 1 out of every 6.
Seriously.
So if Rocket Mortgage offers $10,000 in closing costs, if you use one of our real estate agents, Rocket's real estate, realtors. I'm going to say the difference between realtors and lenders when it comes to, like, you guys are so used to us losing the deal if a builder's offering an incentive, right? That's just it's. I've gotten used to it.
It happens. Yeah.
But imagine if you're as a realtor, you lose a deal because the other realtor is coming from a source that's offering $10,000 in closing costs to the consumer, and you lose that deal. See, realtors haven't realized that you guys are about to sit in the same seat we've been sitting in with new construction for years and years. We've gotten used to it.
Yeah.
But that's about to happen to the real estate world real fast.
Yep.
So if I'm not offering something of value to that consumer to stay with me and not go with an in-house lender for the builder, as a real estate agent, you guys have to have value to your consumer.
Yeah.
That's above and beyond what they're going to be offered by, quite frankly, a conglomerate. It's going to be really important.
It is crazy. All right, Michael. All right. I mean, I said it to this lady yesterday. It's like, I said a long time ago, ever since COVID, I have quit thinking that we're going to have some predictable year, because we don't. And again, here comes something wild and crazy. Something's wild and crazy, and it's only April.
I know.
Yep. We have no idea what the rest of this year is headed for.
So true.
Give us final info on interest rates. Where can you project? What are you telling buyers right now?
I'm saying the next 6 months, we're going to see it down in the 5.5 range, 5 to 5.5 the next 6 months. That's exactly what I'm telling people.
Okay. So if I'm a buyer and I'm like, gosh, I saw it was 6% yesterday. Now it's 6.5 today. Now you're saying it's going to go to 5.5. What do I do? I want to go buy a house. What do I do?
You just really talk to your loan officer, talk to your real estate agent, and get pre-approved in the meantime. Just make sure you have the pre-approval in hand. It's good usually for 90 to 120 days. There's nothing wrong with having that piece of paper. So it doesn't cost you anything usually. And as long as you ask the mortgage company to do a soft pull and not a hard pull on the credit, it doesn't hurt your credit either. So I always tell people, get the letter in hand, like listen to your realtor, like have a letter in case you find something, because it's a lot more difficult to get pre-approved in like less than 24 hours from the time that you're about to make an offer on a multiple offer scenario. So just get pre-approved first. That's number one thing. And then just trust your real estate agent to lead you down the right path with the people that they put in front of you.
I think now more than ever, it's critical, like you just said, that you are like, this is my real estate agent, this is my lender, because these interest rates are swinging on a daily basis. And it's like, like if you weren't watching the rate, someone could have caught a really great rate Friday, it's like, now it's gone. And will it come back? Sure. But you got to have somebody that's watching it like you are. Right. And so I love that. Thank you so much for that.
Thanks for having me on. I really appreciate you.
Heck yeah. Hey, Michael, how can people get a hold of you if they have questions?
Just call me at my number at 832-771-7295. I did forget to put that number on here. Or you can just reach me at michaelhomeloan.com. It's singular. So Michael and then homeloan.com.
I love it. You guys, there's hope ahead. There's brighter days ahead. We just got to muddy through this stuff and everything's going to be okay. Get with Michael and I. We'll help you through it, you guys. And y'all have an awesome day today. Thank you, Michael.
Thanks, Trisha. See ya.
Bye.
Bye.